Thank you for joining us. I'm Peter Simpson. I run the discretionary portfolios for the GP Wealth team within Shaw and Partners. I have with me Martin Crabb, who is Shaw's Chief Investment Officer and controls the asset allocation decisions within Shaw's, and also runs a number of model portfolios across different risk profiles. Markets have been extremely volatile, which always provides some opportunities. With so much going on, we're delighted to hear your analysis and where value can be found in this difficult market. I'll pass over to you, Martin.
Thanks, Peter, and welcome everyone to today's call. I'm just going to use a few slides from a very recent macro morning meeting that we do regularly here at Shaw and Partners, just to frame the discussion that Peter spoke about, which is, volatile markets creating some opportunities. So obviously it's general advice in nature. Why worry about doing asset allocation at all? Why don't you just buy shares and leave them alone? Because shares over long periods of time outperform every other asset classes. As the chart there shows, there are long periods where bonds do better than shares, and you're better off being in bonds. And there's long periods of time where the market just goes nowhere. Unfortunately, it gets in the doldrums like it did in the early 1970s. So it is definitely worthwhile focusing on when's the right time to be in defensive versus aggressive assets. And there are periods when bonds outperform. Generally speaking, monetary policy is the key. So what do we mean by that? Is what central banks are doing to interest rates, and more importantly, what's the shape of the yield curve? So without getting too technical, we have an inverted yield curve at the moment in the world's biggest capital market, which is the US bond market. Long duration bonds are trading at a lower yield than short duration bonds, and that typically doesn't happen. Typically, you get higher interest rates in the longer term because there's more uncertainty the further out you go, so you want a higher return to lock your money up. But what we've had in the past 18 months or so is an inverted yield curve, and that's generally a precursor to recession. It's very good at predicting recessions, not always, but most of the time in history, when you have an inverted yield curve, you have a recession. So basically, you avoid equities and you stick all your money in bonds, and you tend to do well. But this year's been different in that we've had a very inverted yield curve, but the economy's been holding up quite well. So in trying to understand that really is the key to equity market investing at the moment, is that we have a very tight monetary policy. We have very high short-term interest rates. They're 5.5 in America. They're 4.1 in Australia. And relative to the past decade or even 20 years, they're very high short-term rates. And so our economy should be feeling the pain from that, but it isn't. And there's a couple of reasons for that which are worth going into. One is the resurgence in China. So China's effectively been in lockdown for 3 years, and they've only really come out of that in the past 6 or 9 months. So that economy started to power ahead, and that's kept commodity prices a lot higher than would otherwise be, because they are the biggest consumer of almost everything in the commodities front, whether it's fuel or food or metals or whatever. Obviously, 1.3 billion people emerging from poverty into middle class and consuming a lot of stuff along the way. So that's kept energy markets buoyant, iron ore prices, et cetera, et cetera. The second is just the transition from fossil fuels to electrification. There's been a lot of investment in that space and a lot of raw material prices that have done very well out of that. Australia, again, is very well endowed with things like rare earths and lithium and other battery raw materials. So that sector has gone from 0% of our economy to probably about 3 to 4% of our share market now is made up of companies that just are involved in that. Thirdly is just migration. Australia is very lucky in that more people want to live here than want to leave here, which is not the case in places like China or Southern Europe, where people are leaving and probably more would leave if they were allowed to. In Australia, we have a fantastic environment and good quality of life and rule of law, etc. So people want to come and live here, which allows us to dial up our migration if we have a tight labour market, for example, which is what we have at the moment. So very low unemployment, but very high immigration means that our economy can grow even with higher interest rates. So we're seeing about 1 million people going to be coming to Australia this year and next year and the year after. And most of those people, touch wood, will find a job and start contributing to the economy and society immediately. So that's a very bullish story. Australia has one of the fastest, if not the fastest growing populations in the developed world. We're growing twice the rate of India in terms of our population, for example, and India is, widely regarded as a fast-growing economy. So there are some idiosyncratic things that make equity investing a lot more attractive than it would otherwise be. So we're going through a period where interest rates, higher long-term interest rates, are dampening valuations in the Australian market, but within that, there's a number of opportunities. So I just sort of jump forward a couple of thousand slides to some of the stocks that we like in the portfolio at the moment. I'm jumping quite a few forward here. Just thinking in terms of quality and growth. So quality is just a measure of the value of a franchise, how consistently it earns money, how stable its return on equity is, and how good its balance sheet is. They're all measures of quality. And then we've got growth. So the capacity of the company to continue to grow its earnings faster than its cost of capital. And I've just got a spectrum here, which is looking at quality and growth. So there are a couple of names we've been adding to portfolios lately. One in the quality growth space is ResMed. CSL's alongside that. They've both been negatively impacted by the discovery of GLP-1 drugs, which are glucagon-like peptides. They're injectable and they can reduce diabetes and help promote insulin production, but they also keep you full, and they also reduce liver disease, kidney disease, and heart disease because they help you get your weight down. Now, ResMed with sleep apnea and CSL with dialysis drugs are negatively impacted. If everyone takes this drug and we reduce obesity, then negatively impact. But they've been beaten up too much in our view. And so we've been adding to those quality growth names in CSL and ResMed. They have been negatively impacted by bond rates. We're at a feeling where bond rates are perhaps peaking around 5% in the US and 4.5% to 5% in Australia, because we think inflation will come down. We're going to see some inflation data later this week that's going to show it continuing to come down. The other name I just highlight quickly, Pete, is just on Qantas. It's widely loathed both by its customers and its staff, and increasingly by the share market, who's asked for the head of, not just the CEO who left recently, but also the chairman and a lot of the board members. So there's a renewal process going on at Qantas, but the outlook for travel spending is continuing to improve. We're hearing that anecdotally. We do surveys, and our partners do surveys of business travellers, and demand for travel is still going up. So we think at 5 times earnings, Qantas has got a lot of bad news priced in. So they're 3 names we've been adding to portfolios lately. So that's a very quick overview of markets and some ideas for you, Peter.
That's brilliant. Thanks again, Martin. So they certainly are value. CSL is 32% off the highs, ResMed over 40% off the highs, Qantas 31% off the highs. So thanks again for your time, Martin. Always insightful. Clients can contact myself or other members of the GP Wealth team for further information. Thanks again, Martin, and we'll do another one soon.
Thank you.